Hello and welcome to the Investing Collective YouTube channel and podcast. Everything that you are going to hear today represents the views of the interviewer and the interviewee as at the date of recording and should not be taken as investment advice. Alan, before we start, could you just remind the listeners who might not have listened to our initial interview what the objectives are of the trust and how do you go about achieving those objectives?
The real objective for the Global Opportunities Trust is to make money. Ultimately, specifically, we're trying to compound the real wealth of investors over the long term with a particular eye to downside risk protection. So in simple terms, when we have lots of ideas that we think are going to make lots of money, then we're tolerant of risk. When we have less ideas, we focus more on downside protection. So the thing that differentiates it, I think, is the flexibility in its tolerance for risk, depending on our level of conviction in investment ideas.
And when you talk about downside protection, you're talking about not losing money for investors. So why is that important at this moment in time and in this moment in the cycle?
Well, do you like losing money?
Well, no one likes losing money, but...
Yeah, we don't like losing money. So, there's a difference between volatility and losing money. Ultimately, volatility we can tolerate, but permanent loss of capital is not something that we want. If you think about the 30 years to COVID, we think of that as the era of globalization. During that period, investing was pretty easy, to be honest. All you needed to do was buy a bit of everything, and ultimately the rising tide floated all boats. We think that many of the drivers of that have changed, and that ultimately on a forward-looking basis, the rising tide isn't going to float all boats, and that you need to focus more specifically on individual investment ideas that have merit rather than rely on a bit of everything going up over time.
If you're coming out of a period where the rising tide lifts all boats, that's why passive's done very well over the recent years, where people have been flooding into it and they've been enjoying that, rising markets over that period. But the traditional way of building a portfolio of 60% of your portfolio in equities, 40% in bonds, or percentages either side of that, depending on your risk tolerance, you're saying that may not be the best way to be thinking about investing now, today, given the way the markets are at the moment.
Equity and bond returns have been extremely good. And when equity markets have gone down, bonds have gone up. They've had low correlation. So you've been able to have your cake and eat it, basically, by allocating to the two of them and just holding on to that over time. But 2022 should have showed everybody that that's not always the case. If you remember 22, we had inflationary pressure that drove equity markets down and bonds down at the same time. And our hypothesis, if you like, our assertion...
And the lower risk your portfolio, the worse you did.
Yeah, so our assertion really is that on a forward-looking basis, equities and bonds aren't going to be reliable diversifiers for each other. We're not saying that they're always going to correlate like they did in 2022, but it can happen, and it's going to happen more often than we've got used to in the last 30-odd years. And what that means is that investors need to adopt a more dynamic approach to asset allocation, but actually also not rely just on broad markets going up all the time. We talk about being agile investors, which to us is the combination of the flexibility to navigate cycles, because we think we're going to have more of them, and shorter, more aggressive cycles, with the willingness to get focused on specific investment opportunities rather than buy a little bit of everything, which was essentially what passive investing does.
And just talk to me about why diversification matters now today, because if that 60-40 might not do as well as it has done in the past in shorter, more aggressive cycles, how do you find that diversification and what do you do about putting that sort of downside protection in place from your perspective in the portfolio?
In the last few months, what we've been doing is rotating away from some of the more cyclical, potentially higher performing stocks that we've got in the portfolio towards more defensive. But the way that we try and go about it is to decouple from thinking about market constituents and benchmark indices and try and think about how different parts of a portfolio perform in different scenarios. And we're constantly running scenarios for how different groups of stocks will behave in different environments, and trying to identify asymmetry, basically, in stocks and in exposures in the portfolio. So groups of stocks that will behave better in a falling market than than people might expect.
Your portfolio for the 10 months leading up to the end of October year to date is up 10%. Share price is up 20% as the discounts closed on it. But that's despite holding, at the end of September, you were holding 44% cash. So some of those stocks that you picked that you think are going to be defensive have done remarkably well despite that.
Cash as well is very misunderstood as a tool for managing a portfolio, I think, because if you use cash offensively, it can help you to counterbalance other kind of risks in the portfolio. So the portfolio looks different to how it would have looked if we had forced ourselves to hold more stocks and have less cash, if you like. We've been able to back certain views and risks in the portfolio more because we had the counterbalance of cash. And I think it's unusual, I think, to see global equity managers use cash actively in a portfolio. It's much more a sort of hedge fund sort of technique. But to the extent that we really don't pay any attention to what the constituents of market indices are, it's a useful tool in a portfolio.
Alan, thank you very much indeed for your time, and thank you for coming back onto the podcast to tell us what's been going on in the portfolio. It's been great. Thank you.
Thanks very much.